Welcome to the Market Brief, where we get straight to the point because it doesn't take long to get you the information that you need to know. My name is Curtis Parker, and I'll be taking you to the top 3 pieces of news that should move the market. All right. So at the end of this video, if you like the format, you like the content, like and subscribe, and also share. All right. But as far as the topics today, we're going to cover interest rates. We're also going to cover the debt ceiling, and we're going to cover AI and what it's doing to the market. The bonus topic today is going to be the Fed Now that's coming out in July. So let's go ahead and start now with the interest rates, better known as Fed funds rate. So the Federal Reserve, they have a target of 2%. So they want to get inflation down to 2%. If you look right here on this chart, you can see that as the Fed funds rate has been increasing pretty much since 2022, we've seen the market pull back, right? And now we have a situation where the market is looking to try and front run the Fed, either pausing and or beginning to lower rates, okay? Because lower rates would obviously send the market back up. So right now, Fed funds rate is about 5%, okay? And what that has done is made treasury yields go up. And in the beginning, as we just discussed, it caused the market to go down. So why are they raising the rates? Well, the reason is inflation, also known as CPI. You can see that when inflation is high, the way the Fed combats that is raising the interest rates, okay? So now the purple line, that is the inflation rate, or CPI, Consumer Price Index, and the orange is the Fed funds rate. So now we have it where they are about to intersect, right? And that's what you want. You want inflation to come down. The Fed rate is up. Once inflation comes down near or at that 2% mark, that's where the Fed should start to reverse. We don't know what they'll do, but logic says that's what will happen. So until that purple line gets down a little lower, we should see that orange line continue to increase. In about 2 weeks, on the 14th of June, we'll get the new interest rate decision. So we'll see if we continue to push that orange line higher, or it pauses right where it's at, and then we see how the economy shakes out from that. So when it comes to interest rates, what should someone do in terms of investing in the market? Well, if you're looking at the SPY, which is an ETF for the S&P 500, it's 3 levels you might want to consider. One might be waiting for that potential 400 price level before you deploy capital, or you might wait for that 427 for it to close above that, because that is your secondary area of resistance. Or you may wait until it breaks above that $450 level, which would signal a breakout to the upside. All right, so that's the interest rates, how they're affecting the market, and what you can consider doing within the market. Now listen, the stuff that I say about anything individual, stock wise, ETF wise, you and I, we haven't spoke on a one-on-one basis, so obviously that's not advice to you. It's more of just insight, okay? If you want advice, you should talk to an advisor. Yes, I am one. but there are others you can consider as well. So now let's move on and talk about the debt ceiling and what that has to do with any of us. So what is the debt ceiling, right? So right here, you can see the debt ceiling is the legal limit on the total amount of federal debt the government can accrue. The limit applies to the roughly $24.6 trillion of debt held by the public, and then roughly another $6.8 trillion the government owes itself as a result of borrowing from various government accounts, like the Social Security and Medicare trust funds. The federal debt continues to rise due to both annual budget deficits financed by the borrowing from the public and from trust fund surpluses, which are invested in treasury bills with the promise to be repaid later with interest, whenever that is. So, this chart in the middle shows the historical debt limit, and anybody can see that this thing has just been going up, up, and up over the years since the 70s, okay, and hasn't looked back since, okay? So another thing is the debt ceiling, if defaulted on, these are the different payments that could get delayed and or just skipped if a deal isn't reached with the debt ceiling. So everything from Social Security payments, pretty much any government payment or anybody under government salary is at risk of not being paid. All right, Medicare, Medicaid, all of that. So these are the things that would be at risk of defaulting on if the ceiling isn't raised or some kind of deal isn't reached. So what we've had is they did get a deal. Yeah, last night, matter of fact, that will pretty much push this down until election time next year in 2024. So it's just another episode of us kicking the can down the road and dealing with it later. For whatever reason, everybody has their views. We're not going to go into that, but just know a deal was reached. So no payments will be defaulted on as of right now through election time next year, 2024. Now, if you look here, these are the different time periods in which the debt ceiling was at risk of default, and the dark navy blue shaded area, that's the market and what it did. And you can see the market shrugged off every instance of the debt ceiling default and just kept running higher. So, past performance, of course, does not guarantee of future results. However, we can see that history has been pretty consistent in terms of the behavior of the market related to the debt ceiling, okay? And this is provided by good friends we work with First Trust. They do the hard work putting this together, but it really shows how the debt ceiling affects the market, which, as we can see, it doesn't affect it at all going that way. All right. So in terms of what to do around the debt ceiling, really the same thing you've been doing. Okay. A deal seems to always get made. So once that's made, put it behind you and just keep doing things as normal. So that's the debt ceiling, right? Now we want to talk about something that's really hot, especially here recently, and that is the AI craze or virus, whatever you want to expect. This AI thing has really infiltrated the market, and anything AI related is just taking off, right? On these earnings calls, all a company has to do is mention AI and their stock is up, okay? So let's look at some of the top three AI companies and what they're doing compared to the market, right? So right here, this chart from YCharts, I put together the top 3 AI stocks compared to the S&P 500 represented by the SPY here, and the NASDAQ represented by the QQQ ETF. So we can see right here that these AI stocks completely outperform the indexes, right? If we look at the SPY, which is represented in green, year to date, it's up almost 10.5%. Okay. If we look at the NASDAQ, which is the QQQ in the magenta color, it's up 32%. So why is it up almost 3 times as much as the SPY? Well, that's because the NASDAQ has heavier weightings of AI exposed businesses. Okay, so that's why you see the the growth is like 3 times as much. Now, if we look at individual companies that are some within both of the indexes, but that are tied to the AI in different ways. You have Google, all right, which they have their Bard or Baird, however you want to pronounce it, which is similar to the Chat GPT that Microsoft has unveiled to us. And anyway, Google is up 40% year to date, over 40% year to date, right? Most are trying to get 8 to 10% per year. This thing's up 40% year to date. All right, let's look at Microsoft. 38% year to date. So over 38% year to date. A company as big as Microsoft still up almost 40% for the year. We're only in June, okay? And then the biggest of them all in terms of performance, year to date, look at this, 172%. That's NVIDIA, okay? NVIDIA is at the forefront of this AI thing because they design the chips that are being used for these AI applications. So in a sense, they are the supplier of the AI craze, which is representative in their stock performance. Okay, so these are your heavy hitters within the AI space. So what do? Let's say you weren't invested beginning of the year, you missed the takeoff in these AI stocks. What do? Well, you have to remain patient and just wait. Wait for things to settle down, wait for the hype to die down, and then you can look to take your position. All right, it's a little bit more moving parts than that, but that's just the summary version of what to do. If you want to talk details, reach out to me. We can talk some of the strategies that we've been doing and been looking at. All right, but I just wanted you to be able to see who's leading the way and why, and what you could do. So now we get into our bonus topic, which hasn't really been making headlines, but it is relevant to us and something that's coming down the pipeline we should at least know about. Okay, and that's the FedNow system that's set to start release in July. So what is FedNow, right? So FedNow, in summary, which I'm going to show you some details here in a second, it will allow for faster processing of electronic, payments, things like bill pay. And, normally when you write a check, there's a few days before that check actually clears with the banks. FedNow will cut that time down exponentially, so that way payments and things like that process faster. If we look right here, so those were the top topics of discussion right now. What I'd like you to do is, if you like the content, you like the way it was delivered, like, subscribe, and share this so that others can, stay informed. And if there's specific topics you want to know about that I can provide a market brief on for you, let me know down in the comments, please, and I'll be sure to comply, and I'll be obliged to provide that for you. you can go to the website fednow.org to get more information. But I'll show you a click path in a second. But for right now, look, FedNow service is a new instant payment infrastructure developed by the Federal Reserve that allows financial institutions of every size across the U.S. to provide safe and efficient instant payment services. So through financial institutions participating in the FedNow service, businesses and individuals can send and receive instant payments in real time around the clock every day of the year, so including weekends, all right? Financial institutions, meaning banks and other institutions in the finance space, and their service providers, they can use the service to provide instant payment services to customers, and recipients will have full access to funds immediately. So that's just going to make things move faster and more efficiently, okay? They're going to be doing it in phases, but the initial phase, like I said earlier, starts July of this year, 2023. But if you don't know about FedNow, go to the website fednow.org. Watch this video here. It's a short video. I think it's like 3-4 minutes, but it breaks down exactly how FedNow is supposed to work, so you can understand and not really take in this information floating around the internet. Some of it being true, some of it being, opinions, some of it being conspiracies or whatever. Here's the facts. We can get it from right here. Again, that website is fednow.org. That'll bring you directly to the FedNow section of the Federal Reserve services site. And then you'll hover over here, FedNow service, about FedNow, and then that will bring you right here to where you can watch the video and get more information on, how the FedNow system is planning to work. Again, I'm Curtis Parker. This was your Market Brief.